You know how we do it. We take a massive stack of research, all the reports and filings, and we boil it all down to the critical insights you need. And if you're watching the tech space at all right now, you know the quantum computing sector is, well, it's less of a race and more of a wild high-stakes marathon. The volatility is just extreme. So today, we're diving into one company right in the middle of that turbulence, Rigetti Computing, ticker RGTI. We've seen these incredible highs and, frankly, some pretty painful pullbacks. The stock's currently sitting around the $22 mark, which is a significant cool-off from that previous peak mania. And really, the question hanging over the entire sector is just survivability. I mean, who has the staying power to actually deliver on quantum advantage? We ran an analysis report that focuses only on Rigetti's balance sheet, and it makes this really provocative claim that they have an ultimate secret weapon against all this market volatility.
That's right. And our mission here is to really unpack that claim. The report actually labels Rigetti's financial structure as anti-fragile. And this status, it says, comes down to two simple but massive factors: a huge cash reserve and, virtually zero debt. So we need to figure out if these two sort of simple accounting figures are truly enough to insulate a high-burn R&D company from what could be a sector-wide nuclear winter.
Right.
And more importantly, why this position is supposed to make them stronger, not just, safer.
Okay, let's start with the big number then. The one this analysis argues the market is, I guess, failing to appreciate or maybe just overlooking because of all the volatility. They call it the $600 million war chest.
It is the headline, and it's really the bedrock of the entire bullish case in this report. Based on data from Q3 and Q4 of 2025, the analysis points out Rigetti is holding approximately $600 million in total liquidity.
And that's not just receivables, right? This is cash.
This is cash or cash equivalents, yeah.
Right.
Ready to be deployed straight into that R&D machine. And to get why this matters so much, you really have to look at the industry itself. This race for quantum advantage, that point where a quantum computer can solve a problem faster than any classical supercomputer.
It's just viciously expensive.
Exactly. It requires specialized talent, unbelievably complex manufacturing, and these very long multi-year development cycles.
So cash in this world truly is oxygen, like the report puts it. But hold on, we saw other quantum companies raise huge sums during that peak mania period too. Why does Rigetti's cash balance stand out now, especially since the market is so much tougher?
Well, the difference, according to this analysis, is sort of threefold. First, the capital was raised very efficiently when their valuation was high, which meant less dilution back then.
Okay.
Second, they've been pretty disciplined about their burn rate relative to the size of this reserve. I mean, a lot of their competitors are now finding themselves back in the market, hat in hand.
Trying to raise money at these depressed valuations?
Yes, and that is painful, massive dilution for their shareholders. Rigetti is completely insulated from that. They're not forced to divert their executive focus from engineering to, constant fundraising.
And that management time is probably priceless when you're on a deadline for revolutionary tech.
It's invaluable.
But let me challenge that runway claim a little. I mean, $600 million is a lot, but quantum R&D can be a black hole for money. Is the report being too optimistic, claiming this cash gives them a runway through 2027, maybe even into 2028? Couldn't they just hit a major engineering wall and burn through half of that, trying to solve one coherence problem?
And that is the critical risk, you're right. The analysis does acknowledge the high burn rate. But the confidence seems to come from the fact that management controls the pace of that spending. Crucially, that runway projection is based on their current aggressive development. If they had to, they could slow down a bit and stretch that cash even further.
Okay, so it gives them options.
More than that. The cash allows them to make offensive strategic moves that competitors just can't.
What kind of offensive moves are we talking about?
Well, think about talent. If a competitor is distressed and has to lay off a specialized team, say experts in cryogenic engineering or something,
Rigetti can just swoop in.
they have the capital to hire them on the spot and integrate them into their own roadmaps or facility upgrades. They can commit to the long-term capital spending needed for scaling up their ship fabrication without worrying about where the next quarterly interest payment is coming from.
So that $600 million is directly tied to their engineering milestones.
It's explicitly connected. It brings us right to the tech. The analysis ties the money directly to the success of their next-gen systems, saying this cash is absolutely crucial for funding the 150-qubit systems and, the ultimate goal, the 1,000-qubit roadmaps.
And the near-term stuff, too.
Of course. It's the engine for the future. I mean, their immediate focus is on the Novera QPU systems, which is their integrated commercial quantum processing unit. But the real game changer is that next step, Anka 3. The $600 million has to pay for the material science, the design work, the testing, all to successfully execute Anka 3.
Which is the bridge to get to the higher qubit count.
It's the necessary bridge.
Yeah.
Without this funding secured, Those roadmaps, they just stay concepts on a piece of paper.
Okay, let's pivot to the second pillar of this financial fortress. This is where that term anti-fragile really comes into play, the debt ledger. The analysis says Rigetti is operating with virtually zero debt. Why does the lack of debt give them such a massive competitive edge, especially when you pair it with that huge cash pile?
In today's financial environment, debt is just an anchor, especially for growth tech. Interest rates are, well, they're still significantly higher than a few years ago. So if a peer company has a big debt load, every time they hit a financing wall or every time they have to refinance, those interest payments are just choking off their operational cash flow.
But Rigetti doesn't have that problem.
They've effectively weaponized a zero debt policy. If the economy slows, if the quantum hype cycle dips again, and capital becomes impossibly expensive for everyone else, Rigetti is fine.
They're just insulated.
Completely.
Yeah.
They are not beholden to creditors or high quarterly interest payments. That $600 million can be focused 100% on R&D and on selling their Novera QPU systems, not servicing liabilities.
So that's the core dynamic. The $600 million is the offense, the ability to innovate and hire.
And the zero debt is the ultimate defensive shield against, macroeconomic headwinds.
It's offense and defense in one balance sheet.
Exactly. And when the market experiences stress, the analysis suggests Rigetti actually stands to benefit.
How so?
As competitors struggle with debt or desperately try to do secondary offerings, their valuations, maybe even their intellectual property, become distressed.
And Rigetti, flush with cash,
Can selectively acquire key technologies or talent at bargain basement prices. That's what true anti-fragility is. You benefit when others fail.
That puts a whole new spin on the consolidation narrative, doesn't it? It's not just about surviving. It's about being ready to conquer when the industry contracts. So if the financial position is this strong, what does the report say about the painful stock price action we've seen?
Yeah, the report definitely acknowledges the pain. They cite the peak high, nearly $58, during what they call the era of peak speculative mania.
Yeah.
So the drop to the current $22 zone has, naturally caused a lot of panic among short-term holders.
That's a massive loss for anyone who bought near the top. But the analysis actually insists this drop isn't a sign of failure. It sees it as something essential.
They call it classic consolidation. It's the necessary cleansing of the system. The investors who were only there for the quick flip, the weak hands, as the report calls them, they've been flushed out.
So they took their losses and moved on.
Exactly. And the result, they argue, is that the shareholder base is shifting from those short-term speculators to long-term institutional investors who actually understand the multi-year timeline the quantum requires.
Which means the valuation is stabilizing on something more fundamental, not just pure speculation.
Precisely. When the analysis looks at the current $7.3 billion market cap, they see a price tag on a company that is fully funded.
Critically, through 2027 and beyond.
To be a market leader in a disruptive, potentially multi-trillion-dollar field. So from that perspective, the decline is a fundamental buying opportunity, especially for institutions that have a 5-year horizon.
And for anyone watching the charts, the report flags that $20 to $22 zone as being absolutely critical. Why that specific range?
That's the range where the analysis believes institutional money is stepping in to create a price floor. They see the value locked in by the financial fortress we've been talking about. If the price holds there, it sort of validates the report's consolidation story. It suggests the foundation is set, and the market is basically saying, okay, the financial risk is minimal, now we just wait for the tech.
Let's talk about that, the technological delivery, because this is where the risk shifts entirely, right? The financial safety net buys them time, but the engineers have to actually deliver the win. The analysis is very clear on its bullish conclusion. Rigetti is safe. But what are the hurdles they absolutely must clear for this cash advantage to pay off?
They have to successfully execute on the next generation of their superconducting chip architecture. The biggest challenge in scaling up superconducting qubits, which is Rigetti's chosen tech, is coherence.
Maintaining the quantum state long enough to do anything useful with it.
Exactly. Maintaining that state long enough to perform calculations, the more qubits you add, the harder it is to keep them all in sync and isolated from, environmental noise. That $600 million, it's not just for payroll. It is earmarked for solving very specific engineering problems related to noise suppression, thermal management, keeping those chips incredibly cold, and improving fidelity.
And Anka 3 is the next big test.
Anka 3 is the immediate benchmark. It's the bridge system that has to validate they can maintain high fidelity while they push toward those 150 qubit and ultimately the 1,000 qubit goals.
So if they fail to hit those performance targets on Anka 3, the cache just burns away while competitors might leapfrog them with a different architecture, like ion traps or photonics. Doesn't that make the report's optimism about market leadership seem a little fragile, even if the balance sheet is anti-fragile?
It absolutely introduces that tension. You're right. The financial strength buys them years of buffer against a hostile financial climate, yes. but it cannot buy them a physics breakthrough. So the report's bullish verdict, calling the dip a gift and assigning a strong buy, it's entirely predicated on the belief that Righetti's superconducting approach is the one that will win the war.
The cash just ensures they get multiple shots on goal.
That's a good way to put it. It's a calculated gamble. The final verdict really hinges on whether you believe quantum is the future and that Righetti's specific roadmap is the one that will get there. This report just confirms they have the security to see that race through.
And that context is so important for the listener to understand. The financial fortress is confirmed. The really hard part, the engineering, is still ahead. So here's the final thought for you to chew on. The analysis report treats this financial position, the $600 million in cash and zero debt, as a shield that is guaranteed to protect the company through 2027, maybe even 2028. That is immense breathing room.
But the report also, pretty confidently, suggested that RGTI could hit $50 again as early as 2026. So, considering how important those long-term 150 qubit and 1,000 qubit roadmaps are, how quickly does the company need to show successful, demonstrable execution of Ankaa 3? I mean, not just promise, but actual, reliable performance. For that cash advantage to translate into the kind of rapid market valuation recovery the analysis is suggesting. The market might be patient, but $50 in 2026, that demands immediate, flawless technical delivery.
That execution timeline is the ultimate question. It's what will determine if this financial defense can truly translate into a market offense. Thank you for joining us as we